Good afternoon, everyone. Thank you for taking the time and being with us here today. It doesn't take an in-depth look at the headlines to determine there's a lot going on in the world. And not surprising, one of the questions that we get asked quite frequently is what impact does this have on our portfolio? To help shed some light on this, we're fortunate enough to have Louis Lau with us here today. Louis is one of the portfolio managers on the Brandis Emerging Markets Value Fund that we hold in some of our portfolios. Brandis Investment Partners was founded in 1974 by Charles Brandis, and its headquarters in San Diego. It's an independent, employee-owned investment advisory firm specializing in value investing. Reaching over 60 billion in assets under management today, it's one of the first investment firms to bring a global perspective to value investing. It's worth noting that the emerging market strategies at Brandis represents 10% of the assets that they manage at the firm. Louis is a director of the investment group and a senior analyst on the financial institutions team and a member of the Emerging Markets Investment Committee. He's also a product coordinator for the emerging markets portfolio. Before joining Brandis, he was an analyst in investment banking and equity capital markets at Goldman Sachs. He earned his BBA in finance with merit from the National University of Singapore and his MBA in finance and accounting with honors from the Wharton School of the University of Pennsylvania. Louis joined Brandis Investment Partners in 2004 and has currently been on the emerging markets portfolio for almost 18 years. So with that, I'll turn it over to Nick and Louis to shed some light on what's happening in the world. Or excuse me, Mitch and Louis.
Perfect. Yeah, so thanks for joining us, Lewis, and yeah, as Mike was saying, and as everyone can likely appreciate here, the last few years has brought no shortage of kind of macroeconomic headlines in the world. My first question to you, Lewis, is how does the Brandis Emerging Market team evaluate the geopolitical landscape? And then as a follow-up to that, how does that influence your investment decisions in the fund?
Yeah, as with everything that we do at Brandis, we take a bottom-up fundamental approach. So we first start with a comprehensive assessment of all the different risks that are facing a company and the industry. And the geopolitical aspect and the macroeconomic aspect is just but one of those aspects of risk that we evaluate. So just to maybe give a little bit more of a comprehensive look, I'm going to share some slides to illuminate kind of our investment process to give the audience a better sense of how we conduct fundamental analysis. So just sending over a request to share some slides, and I'm not sure if it's been approved, but yeah, okay, now we can, okay. So are you guys able to see this?
Yep.
Key sources of volatility. Okay, so as we mentioned, the geopolitical aspect kind of in the top right-hand corner is one of the, different risks that we evaluate. We also look at very company-specific risks, in terms of their competitive advantage, in terms of what the company can earn over a reasonable cycle. We look at the company's products, the industry, and I'm going to kind of bring it to life for you guys on the next slide, which is alongside a lot of these geopolitical risks on the left-hand side, including currency risk, regulatory risk, competitive risk, there's also a lot of positive aspects of emerging markets. So, a lot of these are fast-growing economies. They're, in the process of developing economically. And a lot of them start with a lower penetration of goods and services. Many emerging market countries are leading manufacturers. We're going to talk about, kind of technology exports and AI in a little bit. But these are some of the benefits that we have to keep in mind while looking at the risks. And the Brandis Emerging Markets strategy has been around for, almost 30 years. And we've seen a lot of crises over the past 30 years, starting from the Mexican tequila crisis to kind of the elections in Brazil, that come about every few years. We're actually on the cusp of the next Brazilian election where the left and the right are pretty much evenly split. I myself started my career in 1997 amidst the Asian financial crisis. I see some Indonesian figures at the background that Mike has, and that's very dear to my heart because the very first day I started at Goldman Sachs, the rupiah plunged 40%, right? And President Suharto was on Bloomberg trying to assure everybody that things were fine, and there was a huge construction bubble that kind of burst during that time. And then kind of fast forward to today where you have a lot of concerns about China and Taiwan. You have a lot of concerns about the tariff landscape, right? So all these are things that we do have to consider when we look at geopolitical risks. Now, one of the things that I want to stress is that the volatility may look very scary kind of in the near term. So this chart shows that on your 1 year basis, the volatility can be minus 50% or it could be plus 80%. But over the longer term, the pattern actually smooths out. And what we need to focus on as long-term investors investing over a 3 to 5 year horizon is that we're trying to capture the very attractive 10 to 20 year annual returns that emerging markets are able to deliver. If we're delivering somewhere between 8 and 12% or even higher returns per year, we would have done a good job, right? But that comes with a lot of navigation, when to add, when to trim, when to sell around some of these risks, right? And so the framework that we use is really a three-part process. The first part is really to screen out companies that are attractive versus those that we'd rather avoid. So in today's political climate, I would say that some of the companies that were very cautious would be Chinese semiconductor, Chinese AI companies, Chinese banks, anything that could get sanctioned by the US government, being a US-based, San Diego-based manager is something that we have to be very sensitive about. And over time, we've actually had less exposure to companies exposed to tariffs because that landscape is also very uncertain. And every 6 months, the president Trump, seems to have a very different take on kind of what tariffs to impose, right? And so those are some of the things that we've been shying away on. On the other hand, some of the more attractive geographies would be Mexico, it would be Latin America, it'll also be Eastern Europe. We're also seeing more ideas from the Middle East. So that's kind of the first part, screening process, and then just maybe to shortcut to the second part is we want to price in a lot of the macroeconomic risks at the security level evaluation, which means taking a hard look at discount rates, what kind of cost of equity we should be applying to different geographies. There are low-risk countries, there are high-risk countries. There's also adjustments that we need to make at the company level, does this company enjoy a currency advantage of producing locally, or are they having currency headwinds of borrowing in foreign currencies, but then a lot of the revenues are in local currency, so they suffer disproportionately from depreciation of the local currency over time, right? So maybe just to keep this short, and I'll wrap up kind of the first question would be, these are some of the geopolitical events that have given the Brandeis emerging market strategy great opportunities to invest in leading businesses, when these things have happened, right? So the majority of our IT position in Taiwan Semiconductor, Samsung, and Hynix was not actually purchased during the AI advent in 2024. It was actually purchased in 2022 when there was a lot of concern about the Taiwan-China conflict. There was a lot of concern about the overhang of tech purchases in the aftermath of COVID. AI wasn't even a thing back then. So as long-term investors, we actually built a lot of the tech position 3 or 4 years before, right? And so we talked about Mexico being a favorable place where exports are actually increasing. Those Mexican positions were built in 2024 when people were afraid of the USMCA going away. So maybe just to cut the long story short and turn the mic over back to Mitch, that would be, in a nutshell, how we would approach geopolitical risks.
Yeah, thank you for that, Louis. And yeah, it sounds very much how I'd expect it. There's lots of macro news out there. It's going to have short-term fluctuations possibly, but you're kind of in it for the long-term investing, and but you do review your positions and make sure that anything in the short term would, if it is going to affect those positions or not. But yeah, so that does kind of bring me to my next point, or my next question. So digging a little bit kind of closer in terms of headlines out there. So one of the biggest shocks that kind of investors and markets have recently seen is the war in Iran. So I'm wondering, maybe Louis, if you could go through some of the implications that the team has seen so far, and going forward for the portfolios from that war.
Yeah, that's a great question, Mitch. So when we look across the global emerging market landscape, some of the biggest beneficiaries of higher oil prices have been oil companies, right? Not a surprise. So what it has meant is that the position of Petrobras, which is the main oil producer in Brazil, has done really well. And so we've actually started to trim some of the names, some of the positions in position sizes in Petrobras, because at $120 oil, that's very far above the normalized price that we normally use, which is about $60 a barrel. In the long run, we think oil prices will come back down to that level. And it's a little crazy because last year we were looking at the oil demand situation, and it looked like oil demand was going to slow down. So we were even thinking about oil going down to $50 a barrel or even $30 a barrel, right? And so today we're finding ourselves in a very different place. So as value investors, we need to be able to react to changing conditions. So that has meant that the oil price beneficiaries have done well. On the other hand, some of the more interesting opportunities that have opened up would be economies that are very vulnerable to oil imports. And in particular, three countries in emerging markets come to mind. They would be the Philippines, Indonesia, and India. So a lot of these countries have to import oil, and a big part of their oil imports actually go through the Strait of Hormuz. In particular, the Philippines has seen the inflation rate shoot up to 7%. Indonesia has coal, and so they're able to offset some of the oil usage with coal, but they've been spending a lot of resources in terms of providing their population with free meals. They've been trying to subsidize employment. And so with the government spending at a very high level, they're in danger of breaching the 3% limit on the fiscal deficit. So there are concerns about how much the government can continue to spend, right? And so Indonesia has also seen a huge sell-off. And this is coming at a time where MSCI has threatened to downgrade Indonesia from emerging markets to frontier status, right? And so the third economy, where it was a darling not too long ago, and a lot of emerging market managers just basically loved India, has become very out of favor because India has a very high import bill in terms of oil. It used to source a lot of the oil from Russia. It's also been affected by higher oil prices. And so the latest from India is that this week, President Modi told Indians to work from home, use 10% less cooking oil, and to try to reduce travel and other activities because they need to reduce their import bill, right? So it's going to have an impact on Indian GDP. It's going to have an impact on the discretionary spending power of the Indian middle class. So these are some of the opportunities that we see, because in the longer term, if there's a resolution to the Iran conflict, oil prices should come back down, and some of these countries' life should go back to normal. We don't know what time frame that is, but we've actually seen many more opportunities for us to add to our positions in Indonesia, India, finding new ideas, as well as the Philippines. A lot of the ideas are in banks, but also there have been telecom companies, food companies, gas utilities. I mean, a lot of these opportunities in the more vulnerable countries. The last one I would mention, Mitchell, is that we're starting to see more opportunities in the Middle East, particularly Saudi Arabia, that wasn't cheap, in the last 3 to 5 years. We've not had a Middle East position for a long time, but we've seen, the attacks on Saudi Arabia and the UAE oil infrastructure causing disruption, causing equity prices to go down. And so that's another area where, again, not to wish on misfortune, but hoping that, more opportunities can come up from the Middle East.
Gotcha. And so looking to add positions in areas where, they might be a little bit more vulnerable to an oil shock, and kind of taking advantage of that in this time and age, and then looking to trim something that's kind of profited from an increase in oil prices. And
Yes.
any thoughts on kind of an increased risk premium in oil prices moving forward after that?
Yeah, things don't go back to normal overnight, right? So with a lot of the oil shipping lines as well as the oil infrastructure being disrupted, you're right in saying that, it might take some time, we don't know when, but maybe 6 months, a year, or a few years for the oil prices to come back down. And so these kinds of risks could persist for a while. And so what the four of us, the committee members on the emerging markets team, is doing is really trying to take kind of a measured pace. So as we're adding to some of these companies, we're adding them slowly, in a sense that we want to make sure that we're pacing ourselves and not going in too quickly, because to your point, this kind of an oil shock, could last several years, and there is a adverse effect. The longer it goes on, these countries could go into more of a deeper spiral, right? And other opportunities might come up, not just the companies that we're adding into today. So we want to be mindful of that. And investing, is a marathon, not a sprint. As we're here to invest in the long term. And while these opportunities are exciting, we have to make sure that we don't subject ourselves to undue downside risk by being too early.
Makes total sense. Makes total sense. So, one other big topic area over the last couple years has been, and I'm sure everyone's heard of it by now, is the growth of AI. So just wondering, maybe Louis, if you could go through some of the implications that AI has on the Brandis emerging market portfolio, or any other thoughts you might have on that subject matter.
Yes. Even though we're a value manager, we've been getting increasing numbers of questions on AI, right? And what the impact is. And maybe I would like to run through kind of some background slides on the effect of AI and what that has had on both emerging markets, the US as well as global markets, right? So, Mitchell, if you guys can see this, the weight of
Yep.
new economy sectors, yeah. So
Yep. You betcha.
this is hot off the press. It's literally like a week old. We just put these deck of slides. I think you guys might be one of the first few clients to see these slides. But basically, this is a contrast, a kind of a 10-year look back on the weight of new economy sectors in equity indices compared to what they were 10 years ago, right? And in regards to AI, the colors to pay attention to would be the dark green, the light green. So those will be internet software companies, semiconductor companies, and then tech hardware, which is kind of like that solid blue block in the bar chart, right? And so what this chart is showing is that emerging markets 10 years ago used to be dominated by basic materials, oil, gas, commodities, financial institutions. But today, the weight of new economy or technology companies in the indices have just skyrocketed, and this has been turbocharged by AI, right? And so the weight of new economy industries in emerging markets has reached 45%, right? And that's kind of an astonishing proportion. And if you look at kind of the two largest companies, TSMC and Samsung, they're at a 15 and a 9% weighting respectively, right? So basically you have almost a quarter of the index comprised of two companies or three companies if you add in SK Hynix, which is just unimaginable compared to 5 or 10 years ago. And then when you look at the impact of AI or new economy industries in the US, that's also very pronounced. You gotta maybe take out the yellow part because the US and the global indices tend to have more pharmaceuticals. So while pharmaceuticals are using AI, I mean, they're not a direct beneficiary of AI, but a lot of AI applications are being used in drug discovery to try to find new ways of testing before they actually test on human or animal subjects. They can run simulations on the effects of pharmaceutical drugs, using AI algorithms, right? And so that could be a good use of AI for the pharmaceutical industry in drug discovery. And then in the global index is a little bit less new economy than emerging markets or the US, but nonetheless pretty significant, over 40% weight in new economy industries. And just to maybe skip ahead to what it means for individual countries, you can see that this is kind of a rough breakdown of the AI haves and have-nots. So I would point out that Canada sits right in the middle, a little bit ahead of Singapore and Japan, in terms of the proportion of revenues coming from artificial intelligence. And there's a lot of nuances if you dig further deeper into these categories, right? But this is just sort of a rough classification of companies that benefit or revenues that are tied to AI versus non-AI. And then on the most extreme end, we talked about Taiwan and Korea being in emerging markets, Malaysia because of the data centers that are being located in Malaysia because they have a cheap source of energy. China and Singapore are building a lot of data centers in Malaysia on the left-hand side, right, in terms of beneficiaries of AI in emerging markets. And then the US ranks as number 5 here. And then on the right side would be kind of the countries we talked about that potentially could be disrupted by AI, and India and Philippines would kind of fall on the other end, right? And so this will be kind of a country, the spectrum of influences at the country level. This is a Brandis approach to looking at the impact of AI on emerging markets. So we have the semiconductor companies and the tech hardware companies, that make servers, memory chips, logic chips, that go into AI data servers on the right-hand side. So these are the AI enablers, including the utilities that supply a lot of the power. And then the middle, kind of the ambivalent middle, if you will, would be kind of the adopters, which are companies that are using AI to make their operations more competitive, more efficient, to lower costs, and also to potentially reduce the reliance on labor, right? Which is kind of one of the side effects of AI. You have internet and e-commerce companies. Half of Alibaba's cloud business is really renting out AI processors for their clients. You have banks and financial services using AI to streamline procedures on underwriting loans, customer service, telecom companies optimizing the network. And then you have kind of companies that are not really affected too much in a big way by AI, consumer staples, real estate, oil and gas, materials. And then on the left-hand side, where a lot of these companies have sold off by 40% year to date, right? So software companies, no surprise, online travel agencies, IT services companies like Infosys, Tata Consultancy, and a lot of these IT services consulting companies tend to be based in India, and they're therefore a big concern about employment and GDP growth in India. So maybe just to skip ahead a little bit, one of the surprises has been beneficiaries of AI cropping up in countries that you would least expect to have a positive benefit from AI, right? So for the longest time, the third partner in the US, Canada, Mexico free trade agreement, Mexico was well known for its auto manufacturing, which is kind of the yellow line. But then because of friendshoring, because of Taiwanese, Korean, and European manufacturers moving away from China, and moving production into Mexico. Mexico has become a very large producer of power equipment going into utilities. It's also become a very big producer of electronics, servers, and all kinds of things that are tied to the support of AI, right? So who would have thought? And the fund has a position in Mexican real estate companies that lease their space to some of these manufacturers. So the fund is, benefiting from this trend. Okay, I think I went too far, but basically, Mitch, this is kind of the lens, the sector-driven lens through which we view artificial intelligence.
Yeah, that's awesome, and you pick up on one that hits close to home to me on the disruption risk, which would be online travel agencies. I know I've used it myself, and then used a chat GPT to kind of try to plan out a travel, and I've heard many people doing the same type of thing. So yeah, that's great. And I know we had you for about a half an hour today. And kind of just before we're looking to kind of wrap things up, and I'll pass it back to Mike to wrap up. But I had one more question for you, and I mean no disrespect or anything, but we always ask. We always like to see that our portfolio managers are aligned with our clients, and so how much of your personal net worth is tied up in the Brandis Emerging Markets Fund?
Yeah, that's a great question. So I'll get to that answer at the end, but maybe just to zoom out and give a general idea, we do have a firm-wide co-investment policy where we would mandate a multiple of our annual average income to be invested in Brandis products. And then within that, a minimum of 30% has to be invested in Brandis products. That's another kind of a mechanism that aligns the portfolio manager's interest with client interests. The other thing that the firm has is also a guideline to invest in funds versus private pools. So basically, the funds that are listed in Canada, Dublin, and the US, we also have to have capital in those funds because that's another metric that Morningstar tracks. In fact, the amount of investments that we have in the funds are publicly disclosed by Morningstar, right? And so that's another metric that would align our interests, not just to the strategy, but the funds in particular. And then with regards to me personally, I would say about 50% of my total net worth or my retirement assets are invested in the Brandis Emerging Market strategy. And we have different, different vehicles, as I mentioned, the funds, the private pools. We have another product that is just solely focused on Asia, but it's managed by the Emerging Market Committee as well. So, the sum total of that means that my future, as well as my retirement, is very closely tied to the fortunes of the Brandis Emerging Market strategy.
Yeah, and that's always good to hear. We like to hear that, a portfolio manager's interest is tied and aligned with the client's interest. That's always helpful and always a question in this industry. But with that, I'll hand it back over to Mike to wrap things up.
So once again, I'd just like to thank you all for being with us here today. There'll be a copy of this presentation on the website in the next couple of days, so if you want to refer back to it. And I just want to give a special thanks to Louis for making the time to sit and talk with us and explain the process that Brandis is using in some of the investments that our clients are holding. It's always fascinating to get sort of the inside look at what the thought process are and the discipline is when we're looking at investment selection. So thank you very much, Louis.
Thank you, Mike. Thank you,
Louis.
Mitchell.
Thanks,
All right.
Louis.
All right, guys, if any of you have any questions or concerns about your portfolios or anything that came up in this presentation, please don't hesitate to give us a call and we'll help you out as best we can. Thank you.